Hello and welcome. This is the India Today Conclave session on Indianomics navigating the global economic slowdown. The world is caught in a state of flux, caught in what seems to be a state of perma-crisis, a permanent crisis of sorts. And one of the biggest questions in people's minds is, how will the economic needle move from here? You would have seen the International Monetary Fund's Global Economic Outlook report. What we'll do with the conclave is try and have some fun, or as fun as economics can get. We have here at the conclave a gathering of some of the sharpest economic minds who track data obsessively and will use their vast insights, experience and depth to tell us whether things are likely to get worse, whether things are likely to stay the same, will we be caught in a state of stagflation, or will things get better? What I'll do is, on the screens behind you, take you through a series of data sets compiled by the India Today Group's Data Intelligence Unit. These reflect the state of the economy across different parameters at this moment. And then we'll get our fantastic panel to tell us where they see things go from here. So that said, allow me to welcome to the India Today Conclave Economy session, Mahesh Vyas, Managing Director and Chief Executive at the Center for Monitoring of the Indian Economy. He tracks data for a living obsessively. Flanking him is someone who does the same, Neelkant Mishra, who's the co-head of Asia Pacific Strategy, India Equity Strategist at Credit Suisse. Pranjal Bhandari, Managing Director, Chief India Economist for the ASEAN region at HSBC. Welcome, Pranjal. Ajit Ranade, now Vice Chancellor at the Gokhale Institute of Politics and Economics in Pune. And Abhig Barua, Chief Economist and Executive Vice President at HDFC Bank. So, can we have a warm round of applause as we welcome our guests to this big session on the economy? And I'll start with that big headline number on global growth. Can we just have the first DIU card at the back, please? The economists don't really need to look at the back because you know which numbers these are. But this is basically the IMF's October outlook, which looks at the global economic projections for growth and also the growth numbers for India for FY23 and for the next year. Now, broadly, and I'll start with Neelkant Mishra, and here I think we want to focus more on the India story in a global context. And the question that's in people's minds sitting here, from where we are, in the way that you see things, are things likely to get better, marginally better, significantly better? Are they likely to stay the same, or could they get a lot worse? So let's start with that. Neelkant.
Thanks, Rahul. So I think the economy is slowing, but from a much higher level than what is currently being projected. So I think the current trajectory of the economy is very strong. That is reflected in very strong numbers for tax collection, for car sales, for airline traffic, and a whole range of indicators. But given that interest rates in India and globally are going up, I think export numbers are starting to weaken quite meaningfully now. And with a lag of, I would say, 12 months, even services exports, so the point at which the US starts to slow, I think there will be a further slowdown as well. So the growth currently is, I think, much higher than what consensus has it at. And I think the economy starts to slow. One point I worry about is a risk of a global accident, because some of these things are what economists would call non-linear. So they don't move like this. I mean, they go this way and then suddenly something breaks, like we saw in the UK. And given that the world has never seen this high level of interest rates, this level of fiscal dominance for a very, very long time, the markets have zero tolerance for policy mistakes. If any of the governments goes through political turmoil, the central bank makes a mistake, the risk of an accident is very high. And when that happens, then there could be a very significant impact on capital inflows and so on and so forth for us. So I think we are going to be fine. I think the steady trend growth should be 7% or so once the bases are adjusted. But we need to be very wary, in Hindi they say sachet, of potential risk of accidents globally.
Abhig Barua, given what happened in the United Kingdom, the kind of policy mistakes that Neil Khan just referred to, does India's political stability provide additional economic stability more than usual, given the fact that the UK, for example, going through constant political flux? Does that essentially be one of the reasons why India seems to be the one relatively stable economy at this time when so much of the other part of the world is in the kind of turmoil that it is?
I think it certainly is a major factor, and it's not just that the government is stable, but it's doing a lot of things to get the economic act together. Take the PLI, for instance, has been very controversial, but it is a move in the right direction to revive a sector that has been neglected for a very long time, and where we have new opportunities given the entire sort of disruption and a reorientation of supply chains. It's ramped up infrastructure spending and so forth. There are a couple of issues that bother me. One is that despite the government's best efforts, the recovery has been very uneven, right? And I'd just like to remind you of a statement that Mr. Subodh Bhargav made recently about Maruti's plans going forward. And what he was saying is that we are going to expand. We are going to put in money in sort of capital expenditure, but that's largely going to be for SUVs and more expensive cars. The demand for hatchbacks, the small hatchbacks, the compact cars, has simply evaporated. Which seems to suggest that with a combination of the nature of the recovery and inflation eating into people's disposable incomes, we have a very, very uneven recovery. So if the government doesn't sort of address that comprehensively, this recovery might not be sustainable. So that's a risk. I mean, there is considerable momentum and so forth. The other thing that, of course, we need to sort of bear in mind, and I think Neelkant kind of referred to, is the fact that on the external side, we have certain very strong sort of pressure points. The large current account deficit and so forth is one. And were there to be a global accident, as you saw in the UK, where a little deviation from the playbook that investors wanted led to that kind of catastrophe, we must also remember the fact that this time around, the traditional playbook for handling crisis, which is to throw money at the problem by central banks, is not available anymore. And I think that's what should keep a lot of policymakers up at night. These are the two factors that I see are important.
I'll call our next card on the screen, which is, Mahesh, specifically to do with the India quarterly growth numbers. And from all the parameters of economic activity that you're tracking, what's your best estimate of this, at this moment, of what quarter 3 and quarter 4 look like in the immediate context of how the Indian economy is revving up at this moment on the back of the pandemic?
So I think that the coming few quarters are going to be slightly slower than what we saw so far. But I think what is important to look at is that these are noisy times. So year-on-year growth rates are extremely noisy because the base can be very bad or the base can be very high, and it's been very topsy-turvy, Q-on-Q in recent times. What I would like to say is that India has survived the turmoil quite well. We have kind of shown that we are quite resilient in very severe shocks, extremely severe shocks of the kind that we saw, and there is still resilience. We're still growing at a fairly good clip. And that, I think, is the most important thing. I think the next 2 quarters will be slightly modest, but look at this. The economy is split into kind of 2 things that I see. I study the corporate sector, and the corporate sector has been doing wonderfully right through. So what it looks like is that the Indian economy is not only resilient in the GDP growth concept in that way, but what is more important is to see that the biggest driver of our growth, which is the large enterprises of India, have done remarkably well. And the entire ops have been more efficient, they have been more profitable, they just don't find the need to invest. They're so good that they don't find the need to invest. So I think in the coming few quarters, we are going to not do too badly. We will surprise most forecasts on the upper side. I don't see too much of a negative downturn. I see a problem in the labor market, but that's a different story.
We'll come to that. Pranjal, with you, we'll spend a moment on the United States and Europe. And if you use your insights to give us a sense of what you think is most likely to happen, there's a lot of talk about the inevitability of the United States going into recession, how prolonged is that likely to be, and given the energy crisis in Europe, how you see the European economic situation go from here.
Yeah, I think the mantra of 2022 globally has been that we have to bring down inflation, even if that means that we are going to sacrifice growth in the short run. I think that has been the main mantra of the advanced economies. And we've seen the impact of that in financial markets across the world. Bond yields have gone up, the dollar has strengthened, equity markets have corrected, but we've also started to see the impact of that mantra on the real economy. You know, we're seeing how household mortgage costs are rising, how household construction affordability is falling, how consumers' real purchasing power is falling, how consumer confidence is weakening. You know, all of these things are coming out of the advanced economies. Now, we are not really forecasting a synchronized recession globally, but what we are forecasting is partial recession. Several countries, several sectors, several households, several corporates are going to go into, recession like economic status over the next year. And I think the repercussion of all of that will be very clearly felt on India as well. As in, I think the last 2 quarters, we've done well in terms of growth, but I think the next couple of quarters are going to be tricky. I worry about 2 drivers of growth. One is exports. A lot of us don't realize the important role exports have played in India's post-pandemic recovery. Just compare June 22 to June 2019. GDP has grown 4%, but real exports have grown 20%. Exports have been a key driver, but now exports volumes could decline, will likely decline over the next couple of quarters, and that will hurt our GDP. And the second thing is pent-up demand. You know, we came out of the lockdown, we started spending, we've spent a lot, we've taken that extra holiday, but at some point with high inflation, we will stop spending. That pent-up demand will run its course. And I think that is also something that's going to sort of hurt growth. So I think the next couple of quarters, we have to be careful that growth will slow a little bit. We shouldn't get, roiled about that. Instead, we should focus on macro stability, keeping inflation low, keeping fiscal deficit on a downward trajectory, keeping, the exchange rates more stable. And I think if we've got that sorted out, then once the global cycle turns, then we will be able to ride high again.
Thanks, Pranjal. Ajit Ranade, let's spend a moment on uneven recovery. This concern that the economic recovery that we're seeing is very K-shaped, that the corporates that Mahesh Vyas was speaking about are doing better than they ever have, and people at the bottom of the pyramid seem to be slipping down the economic curve. That is disturbing. It's also a fact. What should be done to try and address it? How can we try and alleviate that concern?
Yeah, Rahul, as you know, we have been running this free food grain scheme, which is 5 kilos of wheat or rice per person, per family, per month for 33 months. That itself is an indicator of what you said, the K-shaped recovery. The fact is that there is a smaller part of the economy, corporates or the higher income brackets, when the stock market does well, it's people typically who are invested in the stock market whose wealth goes up, and that tends to be typically higher income people. In fact, hardly 3 or 4% of India, if at all, is invested in the stock market. So that's the K, upper part of the K, but the lower part of the K is almost perhaps 80% of the population. But the small kind of ironic fact is that the big upper part of the cake perhaps contributes the bulk of economic growth. So if we are going to discuss only GDP growth, the numbers look good because a small part of the economy contributes disproportionately to GDP growth as well as to profits, as well as to tax collections. But electorally, or even, otherwise, a large part of the population is struggling. Even in the incorporated sector, I think the SMEs, the micro and small medium enterprises are struggling. Rural wages, I don't think have seen the kind of growth that you've seen in other parts of the economy. And therefore, that's a challenge. So I think the government will have to continue its policies of a little more stress on redistribution. If you remember, the finance minister also said a few weeks ago to the Indian corporates, why are you guys not investing? So there's a concern that unless investment comes back in a big way from the private sector, that's not going to, we won't have the job growth.
I'm coming to capacity utilization and investment in just a moment, but I'll come next to inflation. And there's a lot of concern in India about rising prices, but relative to the level of inflation in other countries, India isn't that badly off. I mean, I just picked Turkey and Argentina as outliers, where the rate of inflation is 85.5, 83.3 in Argentina. Even in a sophisticated developed economy like Germany, it's at 10.5. The United Kingdom at 10.1. India is at 7.4, which is slightly lower than even the United States. So Nikan, where do you see inflation go from here? And when I ask this question, I'm asking it mostly from the perspective of those who are watching you here at the conclave and sitting on TV or on social media and watching it, which is consumer price inflation.
Yeah, so if you think about CPI, we look at year-on-year trends, but one of the problems with year-on-year is that it's a slow-moving indicator in the sense that if oil prices went from 70 to 100 back in March, April, and they have more or less stayed there, for 1 year, the year-on-year number will look high. Whereas if you look at incremental indicators, meaning the CPI, the index, the consumer price index, how is it moving month on month versus how it used to move month on month in prior years, what you'll find is that the incremental inflationary momentum is actually of a much lower pace, right? So it is definitely not 7.5, it is closer to the 5.5 range. The second aspect is that the excessive fiscal stimulus that we have seen in the developed world is transmitted through the goods supply chain to countries like ours, because the US is not a big exporter of services, Europe is not a big exporter of services in terms of the percentage of GDP. And therefore, if the goods supply chain globally is already going into recession, so you may have seen Taiwan's year-on-year export numbers have turned meaningfully negative now already. The tech supply chain is seeing sharp order cuts. So the goods supply chain, in fact, even food prices globally have started to correct. And therefore, the imported inflation component should start to moderate as we go ahead. And if we are in the June quarter next year, September quarter next year, we are talking about a lower level of inflation, significantly lower level of inflation than what we see right now. It may still be higher than the 4% level that is target. And I must say that the evidence of corporate capex coming back, right? So the order flows for capital goods companies have been surprisingly robust in the last 6 months. Suggests that companies do have some pricing power, which suggests that they are in a position, that is why they're doing some capex, and which means that inflation will be higher than 4%, but I think it will moderate from the levels we're seeing.
Mahesh Vyas, this 7.5 number is from September for India. Give us your best sense of how the rest of the year this needle is likely to move on the question of inflation.
Well, I expect inflation to remain elevated for some more time. So I don't expect it, of course, to come down to the 4% that we would like it to come down. It's unlikely to come down to even close to 6%. So I expect inflation to be between 6 to 7% or thereabouts. It's unlikely it will go much higher, but commodity prices are not fully predictable. But I don't think any spike in inflation, I don't see it coming down much as well. More or less where it is right now.
Abhik, in the manner in which inflation is being addressed by the government and by the RBI, do you see the need for the government to be doing more? How should inflation be targeted? Is there anything at all that can be done given the global economic uncertainty, concerns on crude? Do you think anything more ought to be done at this moment to be able to keep inflation in check?
I think there is, and I think the finance minister recently, just a couple of months back, pointed out that inflation is not just a monetary phenomenon, and that's true across the world. I mean, we've had severe supply side, disruptions, and now, the name of the game is to blame the central banks for printing too much money. But there was a strong supply problem there. And in India, we've had sort of chronic supply side issues, which tend to aggravate inflation. Food is one of them, and so I think a lot of sort of supply measures, coordinated measures across central and states, particularly in essential commodities, might just do the trick. I think monetary policy is, in India's case, and not just for now, but in general, is perhaps too blunt an instrument for handling inflation, which in India tends to be very, very complex. I think in the developed world, inflation is an easier phenomenon to sort of understand and hence to address.
Okay, I want to come to the question of interest rates, and I'm going to get Pranjal to tell us where she sees interest rates go. This broadly gives you a sense of how interest rates in India stack with interest rates globally, and the kind of increase that we've seen from January this year to November this year, where in India, for example, you've seen the RBI's interest rates go from 4 to 5.9%, in a country like the United States from 0.1 to 3.9%, in the Eurozone from 0 to 2%, in the United Kingdom from 0.3 to 3%. There are two views on this, Pranjal. One is that all the shocks that ought to have been meted have been meted, and now there is no need for a 0.75% kind of basis increase in interest rates. The other is that may be too premature to declare at this moment, and there may be more monetary shocks required. Where do you come out on this?
Yeah, I think this is an interesting question with not very clear answers. I think the big uncertainty right now is, when does the dominant risk move from high inflation to weak growth? Last couple of months, it's all been about, how do you solve the inflation problem? But at some point, once growth globally begins to slow, all central banks will then sort of move their focus a little bit more towards growth. But when exactly that pivot happens, I think that's very hard to predict. Our own sense is that, the Fed, which everybody is watching right now, has about 2 more rate hikes to get done. For instance, one in December, one in February. And I think, most of the other economies, advanced economies, and also emerging markets like India probably have a couple of more rate hikes to do. But at some point, there will be concerns
big rate
about
hikes
growth.
or marginal rate hikes, moderate rate hikes or massive rate hikes?
Look, earlier this week, the Fed chair made it very clear that they don't want to stick to 75 bips. They want to bring down the quantum a little bit. But in the same breath, he also said that the terminal Fed rate might be higher than they had been forecasting a couple of months ago. So he actually confused markets to some extent, and markets actually came out being a little more hawkish. They thought, Fed is going to hike more than they had thought earlier. So I think this sort of uncertainty is going on right now. But my sense also is that come 2023, at least in India, we'll be talking a little more about growth slowdown than we've been talking in the last couple of months. And then there will be pressure that the RBI stops hiking rates. So in a way, we are expecting the RBI to hike by about 50 basis points in December, and then take a pause after that and see what happens to inflation. But the inflation problem will remain. I agree with Mahesh that it'll be very hard to bring down inflation dramatically, and eventually a lot more may have to be done by the government. 50% of our basket is food. At some point, the government will just have to take nimble supply side steps, selling, buying, importing, exporting. That might become the main way to keep inflation lower, particularly in a pre-election year. So I think we'll have to move away from a monetary policy response more towards supply side management to bring down inflation, once 2023
Ajit
comes.
Ranade, how valid is the criticism that the Reserve Bank of India moved too late, that there was a problem brewing in the horizon, they could see the clouds gather, and they didn't bother to move till they were left with absolutely no option but to move, and then therefore march ahead with dramatically high increases in interest rates?
if you look at your graph, Rahul, actually the early one on inflation, India's deterioration in its inflation numbers is not much worse. In fact, it's probably compared to the other countries, the sharp rise was not that high. I'm not trying to defend the RBI, but therefore I think one can debate that. But on balance, I think the RBI has done well to kind of refocus, and they had these meetings of the MPC, unscheduled meetings to tackle. But basically, as my other panelists are saying, this is a problem which is very tough. Just interest rate hikes are not going to do it. We need administrative measures. The fact that in India, unlike the West, most of the inflation is going to be confined to food and fuel. So we should focus on strategies which will dampen those prices. I think the food scheme is really helping. It's probably needed to be extended because we forget, apart from the nutrition needs, it's also keeping inflation low. And on the fuel, I think the government should look at its excise policies on petrol and diesel. That will be also required apart from RBI's actions.
Okay, let's come to currency. I'm just trying to move the needle so that we can go through all the data sets that I have and we can keep coming back as we just did. Now here is how all global currencies are under pressure against the US dollar. Except for the Russian ruble, which we know for reasons which has nothing to do with the economy, but more to do with the war that's currently on, is up 18%. The Singapore dollar has depreciated 4.4%, the yuan 14.2%, the euro 14.2%, the yen 27.8%, the Indian rupee 11%. Now this, Mahesh Vyas, is also a very contentious political issue, where the government is under attack from the opposition for not doing enough to be able to protect and defend the rupee. They've spent a lot of forex in trying to do so. Is enough being done? And more importantly, where do you see the rupee settle in the medium term?
I think it is good that the government is not willing to come too much under pressure on the rupee front. We are seeing the rupee slowly depreciate. We are seeing the RBI intervene on and off to largely control the volatility in the rupee. But I think whether it is this government or any other, it is difficult for anyone to actually plug or kind of stall any direction of the rupee. I think if it is depreciating, so long as it doesn't depreciate too volatilely, if I may use that term, I think it's fine. And that's what I read the government seems to be letting it be. And that I think is fine. We have a difficult situation. The government is saying that it's kind of indicating, the MPC members are saying that they may not intervene too much into the interest rate scenario now. The US has raised interest rates, in which case we will have some greater depreciating rupee scenario going forward. That has an implication on inflation. One needs to see how bad will the inflation situation get by imported inflation. How much will we tolerate that? So the big problem is inflation, and I think politically inflation above 10% is where it hurts. It's not 7%. So we have a lot of headroom over there politically. I'm not saying otherwise. So a rupee can depreciate. I think it may be allowed to depreciate. Economic forces seem to suggest that it will depreciate a little more, but that depreciation may not be too volatile.
Abhi, the rupee's already breached the 82 mark against the dollar. Where do you see the rupee settle in, say, a medium to short term from here?
Look, I must confess I'm a bit of a betting man. So I'm going to buy the dollar at levels of at current levels, or if it drops a little towards 82. And I'm going to sell the dollar at 84. This is not a bet that... This bet has certain macroeconomic assumptions built into it. I think the dollar, in terms of an index, we use the DXY index, is perhaps close to a peak. I think I see portfolio interest returning to Asia, and Pranjul might be able to tell us a little more about the renewed interest in both India and the ASEAN. And I think things are changing, but in the near term, there is a possibility of the rupee seeing another bout of depreciation. But at 84, I pull out all the stops and buy the rupee.
Neelkant, there's a lot of debate at this moment about the continued centrality of the US dollar and whether the Russia-Ukraine war and America and the world's moves against Russia have shown that you need to bolster your own currencies, and we're seeing China attempt to do it to some extent. India is making noises. Do you see this actually pan out in the years to come, or do you think the continued centrality of the dollar is inevitable to global trade, and no matter who says what, that's more from a political, nationalistic perspective, it doesn't change the economics on the ground?
So there's a cyclical aspect to it, there's a structural aspect to it. So the structural aspect of the dollar being the reserve currency globally, it seems unlikely that that will change unless we see an alternative. So if you remember, the UK stopped being the largest economy in the world sometime in the 1870s. The shift from the pound to the dollar happened in 1930, right? 1932. So this is something that takes a very long time. Currencies are a human creation, it's a myth. And which myths people choose to believe in, you need to have an alternative. If you don't believe in the dollar, what do you believe in? There is no alternative. So the structural story on the dollar, I don't think will shift. Cyclically though, currently what we are going through is a panic. See, globally, if you want to borrow money cross-border, you have to borrow in the dollar. That's the most common currency that is available. When you borrow in dollars, you are naturally short the dollar, right? So if the dollar appreciates, you are in trouble. So at the first wave of dollar appreciation, everyone who has dollar debt tries to roll it over, tries to find dollars that I don't want this dollar debt, I want to repay it, which increases demand for dollars even further. And so that's the cyclical rise that we are seeing. I think sometime in the next 12 months, we are going to see an equally sharp reversal of that process. And some of the pressures that we are seeing across the world right now will start to fade. The point is, before that starts to happen, will we see an accident or not?
So you're roughly in the Abik model as well?
No, I think that our problem is less about the level of is less about where the rupee settles, and because it's very hard to forecast, but the fact that we have a balance of payments deficit. See, we import oil, we import a lot of coal now, right? So, and the coal prices are 3x, 4x of what they used to be before the war. And what that means is that we need to bring down our imports, we need to get up our exports, we need to increase our capital inflows. And I think the rupee needs to weaken from here. We should not be under any illusion about a strong rupee being great for India or whatever. I think there is a necessity for the rupee to fall from here to close the balance of payment deficit. I think the pace at which the RBI is burning reserves is too rapid, and I think we need to let the rupee weaken a bit from here. And given that it is done better than even the yuan, where the bilateral trade deficit is still now approaching $100 billion, is something which from even a medium-term perspective is not desirable. So I would focus more on the BOP deficit. If the BOP deficit remains, I think the rupee should keep depreciating.
You can keep allowing the rupee to depreciate, Pranjal, but you'll also come under fire from the opposition, which thinks the government has done a terrible job of trying to protect and defend the rupee. It's linked to the age of our politicians, and it becomes very complicated politically. Political fireworks aside, your broad sense of how the rupee is faring relative to the dollar in a global context, and what could happen from here?
Actually, the rupee has been a relative outperformer. The dollar has strengthened 18% since the start of the year. The rupee has weakened only 11%. And regional currencies have weakened about 14.5% to 15%. So the rupee has actually done relatively well. I agree with Neelkant when he says that letting the rupee weaken right now is probably the best thing we can do. The big problem we have right now is a trade deficit which is very high. What's really driving that is the fact that India's growth is stronger than world growth. We are buying from the world far more than we are selling to the world. Imports are outpacing exports, and we are seeing, a large trade deficit.
So just pause that for a second. I'll call the trade data set on the screen, and then you can explain what you're saying and why, and then we'll build on that. So can we have the graph on trade, which shows how the gap between imports and exports is actually increasing, and that's the deficit that Neelkant was speaking about. But go on.
Exactly. As you can see in the last sort of two readings, exports have actually fallen and imports continue to rise. And that is what is creating this trade deficit, which is weakening the rupee. So what do you do when you have such a big trade deficit? I think the best thing you can do is follow a two-pronged strategy. Number one, increase interest rates. So people stop buying too much, they stop importing too much, and also let the rupee depreciate so your exports become competitive in the global market. Thankfully, the RBI has started to do this now. You know, until August, it was only raising rates, but it was not letting the rupee depreciate. Rupee was stuck at 80. It's only since September, it's doing both. It's letting the rupee depreciate and it's also raising interest rates. And I'm happy to say that finally we are giving the right sort of policy response to this problem. And I think we are on track to, you know, solve our external imbalances over time.
Ajit Rannade, the growth in exports is touted as one of the Modi government's big achievements. Piyush Goyal will be at the India Today Conclave in the evening, and they're talking about how Indian exports have started to bounce back and do much better than they have in terms of growth for a very long time. But the fact also is that the gap between imports and exports, that bridge which you can see, the blue marking there, continues to grow. What's your forecast on how the export curve moves from here? And what can we do to try and reduce imports?
Indeed, last year, India's export performance was really spectacular. I think we clocked something like $430 or $440 billion. This year, I think we are on track to probably reach $400 billion. But I must point out, Rahul, that when you showed the currency depreciation, you know, India is down 11% and everybody else, you know, 14% China. But everyone else is a net exporter. India is the only trade deficit country, so we must worry much more about the currency, and we must worry about the fact that our trade deficit this year, the current account deficit, is going to be alarmingly high, possibly 3%, and we should ask ourselves, why are we importing 1,000 tons of gold? We're spending precious $50 or $60 billion just importing gold, despite an import duty of 15% or something like that.
So what would you suggest?
So, you know,
be careful. You have to go back home and you got family and friends.
No, this is, by the way, the tiny part of it goes to the jewelry, but basically, I believe Indians import gold, apart from their, you know, love of the yellow metal, is because it's a proxy for owning foreign assets. Since we don't have capital account convertibility, you're not allowed to own foreign assets. A proxy for that is to own gold. But I think gold is a very big drain on our foreign exchange, especially on a year when we are worried about the trade deficit. And the other bright side is that on the IT and software exports, we are going to clock something like $250 billion of services export. And the PLI scheme is targeting something like 45% or 50% of output is committed to export. So that's the bright side on the next few years. But we must worry about very large gold imports and this widening trade deficit.
Abik, let me use your insights to get you to suggest a question that I should be asking Piyush Goyal this evening. Here are the rate of growth of exports and imports. The rate of growth of exports is in the blue line. The rate of growth of imports is the dark red. Imports growing at a faster clip than exports. What, according to you, should the government be doing at this moment to try and ensure that exports are growing faster than imports?
Well, there's a limit to which you can actually expand exports. Making your currency competitive is one of the solutions. But let's not forget that there is a very fine line between depreciation being a competitiveness enhancing factor and being seen as a sign of our weakness on external balances. Global demand is weak. So I think we have set in motion some structural measures. The PLI, for instance, there is a large opportunity because of what is happening in China. These will play out in the long term. I'm afraid I cannot be very sort of bullish on export prospects going forward, given that the whole world is turning down. So what we need to do when we have a current account problem is focus on imports and the bits of imports that we can curtail. And I might sound terribly regressive on this, but perhaps we need to have a little more protection, increase import tariffs on certain things, put some kind of a ban on certain exports like gold. And I think we are not going to sort of get too much of a rise in exports. We have an external imbalance problem. We have to focus largely on looking at the import piece, which is also related to things like imported inflation.
Okay, so we have about 5 minutes left, and in the time that I have left, I'll now call on the card on capacity utilization, which is also linked to private investment, which seems to be stuck in the mid-70s, and stuck in the mid-70s for a very long time. You see in the pre-pandemic quarter of FY20, it's at 73.6%. When last we culled out data, it's at 72.4%. Nilkant, you mentioned that you're now seeing this curve go up. Give us insights into what you're picking up, and why is it been stuck in the early to mid-70s for so long, and when does it actually reach a zone where private industry starts investing, which is what people sitting here would like, which is what finance ministry would like, which is what the prime minister's office would like, but somehow despite all the talk, it simply hasn't happened so far.
So if your GDP is, as per current projections by the consensus, 10% below your pre-pandemic path. So if you were growing at 6.5% a year pre-pandemic, and if you would have grown at that pace, you would have been about 21% higher than FY20 in FY23. But what you are currently at is only about 8 or 9% higher, and that means there is a substantial gap in between what you should be producing, or what you would have produced, and what you're producing right now. I think it's a matter of time. I think in 6 months' time, so you may have seen the December quarter airline schedules, for example, and this is a very small part of the economy, but indicative of how the opening up of the economy has been steady. And I would say that in 6 to 9 months, and there are several sectors where the accretive capex, so there is always maintenance capex that keeps happening, but capacity enhancing capex is actually now starting to happen in large sectors like autos, where production was constrained because of supply issues the last 2 years. Their production is now starting to normalize, and you will see, I think, in the next 6 months that the utilization as well as the reported capex numbers will look a lot healthier. I must say that if you talk to capital goods companies, some of them are reporting extraordinarily strong numbers. In fact, their growth rates are astonishing. And I think in some pockets, this capex has already started picking up meaningfully. I think in the next 6 months, this number can be meaningfully better than it is right now.
Mahesh Vyas, this is a matter of great frustration for the Modi government. The whole premise behind reducing corporate taxes in the way that they were was that they'd see capacity utilization go up, they'd see private investment go up, which hasn't happened, and part of it is of course to do with the pandemic, the lockdowns, which are now easing, and therefore everyone in government and outside waiting for private investment to finally kickstart in a meaningful and sustainable fashion. Do you see that happen now?
Well, very, very partially. So we do track at CMI the announcement of new investment projects, and we have seen a little uptick in that. So for a long time, that increase in private new capex was essentially from the Adani and Ambani group companies, some from JSW, but all these very large companies. In the last couple of quarters, we have seen capex come from completely new enterprises, largely in southern India. So in addition to the known large investors into infrastructure industries, we are seeing some others come in as well. Secondly, many state governments have become more active than in the past. So this is now past COVID, and whether it is Rajasthan or Tamil Nadu or many other states, all of them are having these summits where they're inviting private entrepreneurs to come and make investments in their state. So that's picking up. So while there is action on new investment proposals being made by private entrepreneurs, I'm not seeing any acceleration or any increase in the completion of announced projects. And when I look at the balance sheets of companies on an aggregate basis, I see that they don't have adequate incentives to make large capex announcements or make capex investments. So the corporate sector as a whole in the past 2 to 3 years, even if I count 21, 22, their growth in net fixed assets has been lower than inflation rates. So we're seeing 2 to 3, 3 to 4% growth in net fixed assets year on year. That's really very bad. It's like in real terms, they're not growing their assets at all on an aggregate basis. This includes infrastructure companies as well. So I think because companies are making a lot of profits, they are not using those profits because of the tax breaks you mentioned into new capex, but initially they took the money out as dividends. In the last couple of years, something more interesting is happening. They're keeping the money and investing it into equity markets. The huge increase in equity investments by companies. So instead of putting money into fixed assets, they are improving their operations and putting the money into the equity markets. So the tax breaks hopefully will play out eventually, but so far the record is that it's not actually paid dividends.
Okay, I want to end this session by looking at confidence. What we'll have on the screen is data on consumer confidence, and we'll get the economists to give us a sense of their level of confidence in the economy going forward. So what you're seeing is the red line is future expectations index. This is RBI data, and the blue line below that is the current situation index, where it seems that as far as the current situation is concerned, from the perspective of consumers, we are back to pre-pandemic levels, and future confidence index, which had dipped very obviously in the middle of the pandemic and the lockdowns, is again back to pre-pandemic levels. So we'll start with Ajit Ranade. We're out of time, so very quick final words in terms of consumer confidence index, in your view, being aligned to the economist's confidence index or not?
See, Rahul, it's still below pre-pandemic. 80.6 is still below 85. So we are still not recovered the consumer sentiment pre-pandemic. So I think this year this fiscal year, we have to contend with the fact that job growth is not strong, investment spending is not really visible, and GDP growth is probably going to come down to around 5% despite a very good first and second quarter. I think next fiscal year, obviously the outlook is much brighter. So I believe next fiscal year we are going to see, and that's going to be the last budget before the 24 interim budget. So I think we'll see there's a lot of expectations in the budget. I think next fiscal year we'll see a much better performance of the economy.
Abhi, does this reflect an economist's confidence index as well?
Broadly, yes, and I would tend to agree with Ajit that the next few months might be challenging, and there are obvious challenges like high inflation, which has sort of turned back up again. But in the longer term, there is reason to be optimistic.
Pranjal?
Yes, I agree that consumer confidence today is worse than pre-pandemic levels. The greatest driver of consumer confidence is wage expectations. If you think your wages are going to rise, you will go out and consume more. What really increases wages over time is investment. In an economy which is growing, investing, adding to capacities, adding to job creation, those are the only economies where wages rise over time. So, we're coming back a full circle. We have to get the new investment cycle started if we want things like jobs and wages and consumer confidence to rise over time.
Neelkant?
I think consumer confidence will continue to improve. We are, as we steadily open up the economy, I think and momentum picks up, and the fear of how bad things can be, the realization that the permanent economic scarring from the lockdowns has not been that high, I think we'll continue to push this up.
Mahesh Vyas?
I agree with all my panelists that the consumer sentiments are going to increase. And I can say that with more confidence because while this is based only on urban respondents, we do a much larger survey including rural India, and they are also giving a thumbs up. So consumer sentiments are rising.
That's the chief executive plugging for CMI data, saying don't look at RBI data, look at my data, it's more comprehensive, but that's fine. I really enjoyed this session. We had some very deep and very sharp insights, and I want to thank this very bright panel for joining us. It's very difficult to do economic modeling and forecasting in the middle of the kind of uncertainty that we see. So it's almost as tough as having to bat on the Perth of Perth, because people will review what you said sometime from now and say, did he know anything or not? But hey, it is very difficult to know given that there are so many unknowns. But Mahesh Vyas, Neelkant Mishra, Pranjal Bhandari, Abik and Ajit Ranade for joining us at the India Today Conclave for the session on the economy. Thank you very much. Can we have a warm round of applause, please?
stay with us a moment, I'll also request Pradnya Popade, Head Marketing Communications, Samsonite South Asia, to present a token of appreciation to our guests.